Hey everyone, welcome back to the channel. This is LC. Today I want to talk about how capitalized interest distorts interest coverage ratio. For you that attended courses like Value Investing 101 or Financial Statements Analysis 101, I'm pretty sure you have learned interest coverage ratio. Formula of this ratio is pretty straightforward. Well, what could go wrong with such a simple calculation? In this video, we will discuss one advanced accounting item which causes impact to interest coverage ratio. I hope after watching this video, you understood the importance of reading footnotes, not just focus on the three financial statements. One of the key areas in analyzing business risk is we want to assess whether a business affords its debt burden. We use this interest coverage ratio to measure how easily a company can pay their interest expenses on outstanding debt. Basically, each of these ratios telling you similar message. You take operating profit, then divide it by the interest expense in income statement. Which formula should you use to assess interest coverage of a business? This really depends on industry. We can discuss this in the future. For example, to get interest coverage of Karex for FY 2017, we take 35.5 million as operating profit divided by 1.19 million financial cost. Then we will get 29.8 multiple. Another example, this Tenaga 2017 annual report. We take 9.3 billion divided by 1.456 billion. Then we will get 6.43 multiple. Calculation wise, it is very easy. After you get the interest coverage of a business, you should do peer comparison and look at historical trends. Depends on industry. For instance, for oil services, interest coverage should be at least 7 times. For airlines, at least 4 times. For telco, interest coverage at least 5 times. In general, the higher multiple, the better it is. Just now, I am showing you how easy to calculate interest coverage ratio. Unfortunately, in reality, it is not as simple as what I have shown you. The devil is in the details. I would like to introduce capitalized borrowing cost, also known as capitalized interest expense, and construction interest expense. This is one type of financial cost that less commonly known by retail investors. Then I will discuss how the capitalized interest distorts interest coverage ratio. Under IAS 23, one of the accounting standards of IFRS, capitalized interest is the cost of funds or borrowing costs used to finance the construction of a long-term asset that a business constructs for itself. For example, a company takes construction loan to construct its new corporate headquarters. The company must be taking construction loan. The borrowed funds need not related to specific projects, but it ties to the qualifying long-term asset. How does finance cost capitalized into asset. The finance cost is rolled into cost of asset so that the interest is not recognized in the current period as interest expense. It is now a fixed asset and is included in the depreciation of the long-term asset. Thus, it initially appears in the balance sheet and is charged to expense over the useful life of the asset. Therefore, the expenditure appears on the income statement will be depreciation expense rather than interest expense from the perspective of accrual accounting. Capitalizing interest helps a user of financial statements obtain an accurate measure of the acquisition cost of an asset and have a better allocation of costs to earnings in the periods when an acquired asset is being used. When booked, capitalized interest has no immediate effect on a company's income statement, and instead it appears on the income statement through a depreciation expense. As retail investor, we have no access to internal documents to verify eligibility of an interest expense for capitalization. We trust accountants and auditors doing their job. Part of IFRS, the finance cost capitalized during the period should be disclosed in PP&E footnote. The policy, amounts capitalized and rates used should be disclosed too. We are not accountants. It is not necessary to go into debit and credit details. I will show you a couple of real-world examples. First example, Karex. Navigate to the balance sheet. Search for property, plant and equipment. You won't find anything about capitalized interest here. You must go to Note 3, which is in page 77. Move down this footnote. Here, included in property of the group is finance cost capitalized of 143,000 at 5% per annum. What does it mean? It means 143,000 of construction interest expense was added into additions of PP&E, 24.9 million. Did you notice note 17 here? Let's take a look of note 17. To reflect Capex properly in the cash flow statement, Karex remove 143 million from the additions. 24.391 million is the Capex, not 24.9 million. Not many companies disclose this calculation in footnote. As you can see in the cash flow statement, 24.391 million is shown in the cash flow statement. Because the capitalized interest was added into PP&E, this amount won't appear in income statement. It means the finance cost here, 1.19 million, did not include the capitalized interest, 143,000. The next example is our beloved Tenaga. Navigate to balance sheet and search for property, plant and equipment. Go to note 13. To find information of the capitalized interest, let's go down. Here it is. Interest capitalized during the financial year in capital work in progress amounted to 1 billion for the group. The capitalization rate used to determine the amount of borrowing costs eligible for capitalization is 6.5%. The interest rate is quite high, and this is quite common for construction loan. Same like Karex, the capitalized interest was added to PP&E and it wasn't appear in income statement. The capitalized interest will be depreciated based on useful life of the asset. The useful life of the asset can be from 10 years to 60 years. Let's take a look of Tenaga Logistics. Navigate to page 47, balance sheet. We do the same thing, look for property, plant and equipment. Note 3. You can find capitalized interest expense here. Alright, it's a bit far away. Here it is. Included in the construction in progress incurred for the year is interest capitalized of 4.2 million at rate of 5.62%. Accounting wise, it is exactly same like Tenaga and Karex, so I won't repeat here. One thing in Tenaga's annual report that worth to take a look is its finance cost footnote, which is footnote 18. $32.4 million was interest payable in FY 2017. Here, Tenaga shown you that they removed the capitalized interest from the interest payable to get the finance cost that appears in the income statement. Some companies share these details, but some don't. Another example is THHEAVY Engineering. Let's go to balance sheet. Search for property, plant and equipment. Go to footnote 5. Disclosure of the capitalized interest is in footnote 5.4. Included in the group's capitalized work in progress is an amount of nil representing finance costs capitalized for the year. As of 31st December 2017, cumulative finance costs capitalized in capital work in progress amounted to 73.5 million. In this case, there was no capitalized interest in FY 17. The cumulative interest capitalized was 73.5 million. It doesn't tell you how many years they take to depreciate this amount. The last example is Kawan. Let's go to balance sheet. Search for property, plant and equipment. Note 4. You won't be able to find any information of capitalized interest here. However, if we go to cash flow statement, check this out. Acquisition of property, plant and equipment, net of interest capitalized. There are two possibilities here. First possibility, they were capitalized interest in previous year. If there was really no capitalized interest in FY 2017, then this sentence was a product of copy and paste. Another possibility, there were capitalized interest in FY 2017, but Kawan didn't disclose the information. What should you do in this case? You should open and read each previous year's annual reports. Did they ever disclose capitalized interest? In matter of fact, the last time Kawan disclosed capitalized interest was in 2015. In this case, we can safely assume there was no capitalized interest in 2017. If you really want to be sure, send email to Investor Relations or ask the senior management in AGM. You should ask them about cumulative interest capitalized and number of years for depreciation. By now, I think you should have good understanding of where to find capitalized interest, how it impacts PP&E, and why it doesn't appear in income statement. Next, the impacts of capitalized interest. The first impact is interest coverage ratios will be distorted because the capitalized interest doesn't appear in income statement. The second impact is the actual borrowing cost may be hidden because the capitalized interest will be depreciated together with the fixed asset. Could be 20, 30 or 60 years. You can find the information in PP&E footnotes, but how many of us seriously read every sentence in annual report? If you are accountant or you really enjoy doing complicated adjustment, you can do what highlighted in this slide. You can read through this slide after you download this deck and do further research if you're interested. I won't take you through this slide. If you are like me, do this. Add the capitalized interest into interest expense when you calculating interest coverage. If the impact is very huge, question the management during AGM. Here are few examples. Impact of capitalized interest to Karex and Tenaga Logistics was not so significant. Impact to Tenaga was very significant. 6.4 times reduced to 3.81 times. For THHEAVY, don't forget they have 73.5 million of cumulative interest capitalized. You should ask the senior management how many years of useful life of assets that tie to this cumulative interest capitalized. Here are a few key takeaways. Capitalized interest is interest that incurred on a construction loan used to construct a building. It is rolled into the cost of the asset. Capitalized interest shows up on the company's income statement through depreciation expense, recorded on the associated long-term asset throughout its useful life. I have also shown you few examples where capitalized interest distorts interest coverage ratio. To overcome the issue, you should add the capitalized interest into interest expense when calculating interest coverage ratio. If the impact is very significant, You can ask the senior management about the depreciation policy applied on the capitalized interest. Also, ask them amount of accumulated capitalized interest, as this amount is often not disclosed in financial statements. Finally, in the video description below, I have provided a link to download this presentation deck and few other references. If you enjoyed the video, give me a like and share it out. If you didn't, a dislike. Subscribe for more, hit the bell, and I will see you in the next one.